Hello everyone and welcome to Kanga Crypto News. Let's start with ETFs because this is where the biggest shift in sentiment happened this week. Bitcoin spot ETFs recorded $171 million in net outflows in a single day, marking the largest withdrawal in the past 3 weeks. This breaks a streak of relatively stable inflows and signals that some institutional players are taking profits or reducing exposure near current price levels. At the same time, total weekly flows turned mixed, with several sessions alternating between inflows and outflows, a clear sign that conviction is no longer one-directional. Now, here's the other side of the story. Morgan Stanley officially entered the Bitcoin ETF race, introducing a product with one of the lowest fee structures in the market, reportedly targeting sub 0.3% levels. This puts direct pressure on incumbents like BlackRock and Fidelity, who dominate current flows. So we're seeing something important. Capital is not leaving crypto entirely, it's rotating between products and providers. ETF flows remain the most reliable proxy for institutional demand. Mixed flows, combined with a new entrant, usually indicate a transition phase where smart money is repositioning rather than exiting. Now let's look deeper at what's happening under the surface. According to on-chain data, nearly 50% of circulating Bitcoin supply is currently underwater, meaning it was purchased above current market prices. This is a significant shift compared to earlier stages of the cycle, where the majority of holders were in profit. At the same time, long-term holders, typically the strongest cohort, have started to realize losses on small portions of their holdings, a behavior rarely seen during strong uptrends. Historically, similar conditions appeared during late-stage corrections or consolidation phases, where weaker hands exit and stronger hands accumulate gradually. This creates structural pressure on the market. The more underwater supply increases, the higher the likelihood of sell-offs on relief rallies, which can slow down upward momentum in the short term. Now, over to corporate accumulation and the surprising signal from one of the biggest players. Strategy, led by Michael Saylor, did not purchase Bitcoin this week, marking the first pause in its accumulation strategy in 2026. This comes after months of aggressive buying during which the company consistently added BTC regardless of price, often above key psychological levels. The pause suggests a more cautious approach, potentially waiting for either better entry points or clearer market direction. It's important to note that Strategy still holds one of the largest corporate Bitcoin reserves globally. When the most consistent buyer in the market pauses, it often signals a shift from momentum-driven accumulation to more tactical positioning. Let's move to derivatives, where a major reset just took place. The market absorbed over $14 billion in Bitcoin options expiry, one of the largest quarterly events. These expiries often act as volatility catalysts, as large positions unwind or roll over. At the same time, over $440 million in leveraged positions were liquidated, affecting both long and short traders. This combination typically reduces excessive leverage in the system, which had been building up during the previous rally phase. Funding rates across major exchanges also normalized, indicating a more balanced positioning between bulls and bears. After large liquidation events, the market often becomes healthier structurally. Lower leverage reduces the risk of cascading liquidations and creates a more stable base for the next move. Now let's zoom out to the macro picture. Bitcoin continues to show a strong correlation with traditional risk assets, particularly tech stocks. During recent geopolitical developments and macroeconomic data releases, BTC moved almost in sync with Nasdaq futures, reinforcing its role as a risk-on asset in the short term. This challenges the digital gold narrative, at least in current conditions. Instead of acting as a hedge, Bitcoin is reacting to liquidity conditions, interest rates, expectations, and global risk sentiment. Even with strong crypto-specific fundamentals like ETFs and adoption, macro liquidity still drives short-term price action. And finally, let's talk about what analysts expect next. The market outlook is currently divided. Some analysts maintain bullish projections, pointing to a move toward $150,000 per Bitcoin in this cycle, driven by ETF adoption, supply constraints, and continued institutional demand. Others are more cautious, suggesting that the market may first revisit lower levels before any sustained breakout, especially if ETF flows remain inconsistent and macro conditions stay uncertain. The market is no longer in the clear trend. It is building a range, and ranges typically precede strong directional moves. Overall, this week showed a market that is cooling down but not breaking. ETF flows turned mixed, corporate accumulation slowed, derivatives flushed out excess leverage, and macro continues to influence short-term direction. Short-term, consolidation and elevated volatility. Long-term, institutional infrastructure keeps expanding and capital is still in the system, so just moving more selectively. That's today's Kanga Crypto News. If you enjoyed this episode, like, share, and subscribe. Stay informed and stay ahead in crypto. See you next time.